Oh, how so close we are to 20,000 on the Dow. We're at 26, 27 points away. We've been as close as 20 points. I see Jeff Sica joining us in the studio. Stuart always likes to introduce him as the perma bear, and he always rolls his eyes. But it'll be interesting to see as we get him seated what Jeff Sica makes of all of this. Jeff, we have been moving sideways for the last couple of weeks. How long do we do this, or is there more impetus to the upside?
I'm going to try really hard not to roll my eyes about that.
No, because you're going to be stuck that way, and that's not a good look.
I think, what this rally is, what the rally we've had for the last couple of weeks has been primarily that investors are looking at this as they want to be at the party when the Dow hits 20,000. But as far as the relevance of it, I think what investors are beginning to realize is there's some very dark clouds on the horizon. And those very dark clouds on the horizon have a lot to do with the things that they've been ignoring as they're trying to get the next inch out of this market.
What are they ignoring?
The first thing they're ignoring, what I see, is they're ignoring the fact that the high dollar, the increase in the value of the dollar is going to hurt multinational earnings. There's no question about that. It's going to hurt multinational earnings, and I think it's going to hurt multinational earnings a lot more than people think, because a lot of the multinationals have been relying on their exports to continue to grow revenue. The second factor is that up to this point, the European banking system has really been a non-issue for a lot of investors. I mean, the fact that we're seeing Italian banks collapse, the fact there's this interdependency between banks is an issue, because interdependency will create an avalanche effect coming out of Europe to banks all around the world. And the third, which is, I think, extremely important, is the central bank. I mean, the fact is, Trump, before he got elected, there's no love lost between Janet Yellen and Donald Trump.
Sure.
There is going to be a battle at the central bank as to whether or not the central bank has artificially inflated asset prices. And if there's turbulence, investors should know that Trump is without a doubt going to blame the central bank for creating this artificial inflation in asset prices.
The ultimate party pooper, Jeff Sica, you've come in here. Literally, we're down, still 30 points away, but strong dollar, European bank crisis, and a central bank crisis. And a partridge in a pear tree.
And I didn't roll my eyes.
When he talks about the European bank crisis without a buzzer, I mean, you should just know that Monte dei Paschi, the Italian bank, they were saying when they got bailed out last week that they needed to raise $5 billion in capital. Well, the ECB this morning said no, it's more like $9 billion.
Yeah, a lot more, almost twice as much.
And we have elections coming up in Europe. In the spring, we have elections in France, I think in the fall, in Germany, and who knows what this means for the euro long term.
You guys are totally bumming out. So I'm going to turn my back on you.
Well, and the European Central Bank is broke. See, that's a problem.
Yes.
They're broke, and they keep making these promises and pretending that they have the ability to bail out these bad banks. It's quantifiably impossible for them to do that as they've promised.
My Christmas cheer is fast disappearing, so I'm going to look over here for brightness and sunshine. Cheryl Casoni joins us now. Cheryl, let's get your view on all of this. I know that 20,000 is only a psychological point, but it is exciting. It does speak to the optimism, which frankly has been stalled just a little bit.
It has, but I think the bond market is really where it kind of tells you where the reversal between the weakness in bonds. I mean, we have seen a nearly $13 billion outflow in the bond market. That was for the month of November. All of that going into stock funds. But remember that you have so many investors that were burned by the recession, and they didn't come back to stocks, even with record after record that we hit in 2016. I think that you're finally seeing, because of what happened with the election results, because of Donald Trump saying that he's going to lower the corporate tax rate to 15%, you're finally seeing the average American willing to get back in. They're getting back in. I think that's a good thing. But to the traders' points, yes, 20,000 is a psychological number. We all know that. But at the same time, it's a good momentum play. And as you come back into the year and volume picks back up, we're on weak volume right now. Take that for what you will. When volume picks up back, when we come back after January 1st, I think that you are going to see a market that's going to continue to go higher. Sorry, Jeff Sica, I respect you very much. I've known you for years, but I think that this train is on the tracks.
Thank you, Cheryl. I feel a bit better now. Let's go out to Scott Martin. You're not rolling your eyes, so that's good. To Jeff Sica's point, Scott, strong dollar hurting earnings, European bank crisis, we're overlooking it a little bit, and the central bank's artificial inflation of assets, all of those things have yet to play out. Would you agree?
Yeah, I think Jeff's right about the dollar and the fact that multinational corporations here, especially in the S&P, get a lot of their earnings, about 50% from overseas. So a strong dollar selling their goods overseas makes those goods more expensive and probably hurts earnings. But I think his correctness ends there, because with regards to Europe, Europe's been a disaster for years, guys. This isn't new news. ECB stress tests, Brexit, the Greek crisis. Everything that's gone on in Europe in the last several years, weak GDP, in fact, negative in some cases. The market already knows that stuff. The market already has gone past that. So it's as far as I believe investments go, you look at the U.S. because that's the safe haven. You look at U.S. banks, stronger than other global banks. That's what's going to keep this market up, not what's going on in the emerging markets or certainly what's going on in Europe.
Jeff, respond to that.
Well, the whole dialogue around Europe, everybody knowing, that Europe's been a problem for a while. I disagree with that. I don't think investors have fully grasped the interdependency between European banks, multinational banks, U.S. banks, the derivative exposure. I hate to cast a shadow over it.
You're right. Deutsche Bank recently really put a shiver through the markets.
Their strategy in Europe has been, let's just pretend that everything is going to be okay, and let's pretend we actually have a fund that could bail out all these institutions.
Yes,
it's been a lie.
Yes.
So as much as it's been out there and growth in Europe has been a disaster, we haven't seen the implosion of the European banking system and what the impact is going to be on banks around the world.
I think U.S. assets, though, and I think U.S. banks in particular, are more protected now than they were. Look at the stress test results from U.S. banks. I think the U.S. banks have seen this weakness in Europe, to your point about growth and GDP over there and here, and I think that they're very well protected.
Well, let me just, as far as that's concerned, what we need to, I agree they're much better off here than they are in Europe, but what we need to see is how much these artificially inflated asset prices and artificially low interest rates have affected banks, have helped banks. When the central bank creates all this liquidity for banks around the country, and the U.S. government, the central bank, is a slush fund for them, they're going to show better fundamentals. That, to me, is an issue. I think when it comes down to it, there's going to come a point where they're not going to have these artificially low rates. They're not going to have this liquidity to support their balance sheet.
Almost like a drug addict is having the drug taken away, in other words. And you say that the withdrawal symptoms are going to be painful. Let me bring in John.
No escaping the fact the U.S.